Finish up with this paper. We are almost, so I'll read out the question, Mr. Martin, then we will try out in a brief way, then read out the marking scheme. So Brande's business partner Fela has opposed the decision by Brande to enter into a business relationship with Lukupoa. According to Fela, their business with Brande was fast gaining popularity and will have been the perfect competition for Lukupoa in Kenya. Fela argued that the resources being used to enter into the franchise agreement with Lukupoa could best be utilized to develop their partnership. After in-depth discussions, the two partners have decided to approach the court for the dissolution of their partnership so that the two partners can pursue their business interests separately. The partners have requested you to write a comprehensive legal opinion on the instances in which the courts may decree a dissolution of a partnership, taking into account to discuss their unique circumstances in each case. So I revisit the question so that we clearly understand. So Brande's business partner, so Brande has a business partner who has opposed the decision by Brande to enter into a relationship with Lukupoa. So the colleague refuses Madam Brande's position that she is joining Lukupoa. And according to the partner, the business with Brand was fast gaining popularity and have been the perfect competition for Lukupoa in Kenya. So Fela argued that the resources being used to enter into the franchise agreement with Lukupoa could best be utilized to develop their partnership. So, and after an in-depth discussion, the two partners have decided to approach the court for the dissolution of their partnership so that the two partners can pursue their business interests separately. So the partners have requested you to write a comprehensive legal opinion on the instances in which the courts may decree a resolution of a partnership, taking into account to discuss the unique circumstances in each case. Mr. Martin, do you have any idea of exactly what the examiner is looking for through a decree for dissolution of a partnership through court?
I guess looking at this question, I think the examiner is trying to be able to ask that we do a legal opinion on dissolution of the partnership and what are the things that we need to be able to take into consideration. And looking at this question, the fact that the partners want to dissolve the partnership, then I think we have to start looking all the way from we look whether, we have to be able to bring the angle of the partnership deeds, if at all, so that we can be able to look at how they need to be able to share out their, how they're going to distribute whatever assets and whatever assets that the partnership has. So I think I'll be able we'll be able to look at it from that perspective. My thoughts. Was indeed has provided for making reference to the Partnership Act, actually.
Thank you so much, Mr. Martin. So let us now delve in to see what exactly the marking scheme said. So a legal opinion, the issue is whether the court may order the dissolution of the partnership between Brand and Fela because they disagreed over Brande's proposed franchise relationship with Lukupoa and now wish to pursue separate commercial interests, and the applicable under Section 44 of the Partnership Act 2012. A partner may apply to court for an order removing that partner from the partnership, removing another partner, or breaking up the partnership. So we can see there is an enabling provision under Section 44 of the Partnership Act of 2012 that allows a partner to either remove a partner from the partnership, removing another partner, or breaking up the partnership. So in deciding whether to dissolve the partnership, the court may consider the following grounds. Incapacity of a partner. The court may consider a partner's capability to perform the duties of a partner under Section 44(2)(a). This covers circumstances such as persistent physical or mental incapacity that materially prevents participation in the partnership business. There is no evidence in the question that either Brande or Fela is incapable of performing partnership duties. This ground, therefore, does not presently apply. Point number 2 is conduct prejudicial to the partnership. Under Section 44(2)(b), The court may consider the effect of a partner's conduct on the partnership business. Dissolution may be justified where a partner's conduct destroys mutual confidence, damages the firm's reputation, or makes continued cooperation impracticable. Brande's proposal to use partnership resources to pursue a franchise with a direct competitor without Feller's agreement could be prejudicial if it diverts partnership funds, customers, or opportunities. It may also conflict with the partner's statutory duties of good faith, disclosure, and accountability. Mere commercial disagreement, however, may not suffice unless it has created a genuine breakdown in mutual trust or management. So the second marking point was conduct prejudicial to the partnership is also a ground. And ground number 3, breach of the partnership agreement. The court may consider any breach of the partnership agreement under section 44(2)(c). The agreement should be reviewed to determine 1. Who may make major business decisions, 2. Whether a unanimous approval is required, 3. Permitted use of partnership funds, 4. Restrictions on competing business, and procedures for retirement, expulsion, or dissolution. If Brande committed partnership funds to Lokopoa franchise without the required approval or intends to compete against the partnership contrary to its agreement, this may constitute a material breach supporting dissolution. Then ground number 4 is on fraud, misrepresentation, or non-disclosure. Section 44(2)(d) permits the court to consider fraud, misrepresentation, or non-disclosure when the partners enter into the partnership or modified their agreement. No fraud or misrepresentation is disclosed in the facts. This ground will apply only if, for example, Brande concealed an existing arrangement with Lokopoa when forming or varying the partnership, or either partner induced the other to enter into the partnership through materially false statements. Then another ground is on illegality under section 44(2)(e). Dissolution may be ordered where an event makes it unlawful for a partner to remain in the partnership. Examples include loss of a legally required license or a legal prohibition affecting a partner's participation. Neither the proposed franchise nor the disagreement is inherently unlawful. This ground therefore does not presently apply. And then ground number 6, losses and prospects of profitability. The court may consider the losses incurred by the partnership and the prospects of continuing its profitability under section 44(2)(f). Dissolution may be appropriate where the business continually incurs losses and there is no reasonable prospect of profitable operation. Feller asserts that the partnership is growing and could compete successfully against Lokopoa. That contention indicates that the business remains profitable or commercially viable. This ground is therefore comparatively weak unless financial records prove persistent losses or that the management deadlock has been profitable operation impossible. Any other appropriate ground. Section 44(2)(g) gives the court the discretion to rely on other grounds it considers appropriate, and these will include the following: irretrievable breakdown of mutual trust and confidence, management deadlock, incompatibility preventing joint decisions, frustration of the partnership's commercial purpose, or circumstances making it just and equitable to end the relationship. This is the strongest ground available to Brande and Feller. They have fundamentally different commercial objectives. Brande wishes to operate under Lokopoa brand, whereas Feller wants to develop the existing business as Lokopoa's competitor. If they share management and voting power equally, their disagreement may create a deadlock over the use of partnership resources and the direction of the business. The conclusion and recommendation will be that the court may dissolve the partnership under section 44(1)(c), principally because the partners' commercial objectives have diverged and their relationship may have reached an irreconcilable management deadlock under section 44(2)(g). Brande's proposed use of partnership resources may additionally support dissolution under section 44(2)(b) and (c) if it prejudices the business or breaches the partnership agreement. So before filing suit, they should review the partnership agreement for a contractual dissolution, retirement, buyout, or dispute resolution procedure. Since both parties agree to separate, a negotiation dissolution deed will ordinarily be quicker and less costly. It should provide for cessation, valuation, settlement of liabilities, repayment of partners' advances and capital, distribution of the surplus, treatment of the business name, goodwill, release from partnership liabilities, and notification to creditors, employees, customers, bank, and the registrar. If agreement on these matters is impossible, either partner may apply to court for dissolution, taking of accounts, realization of assets, payment of creditors, and distribution of the remaining partnership property. So a quick recap to understand what we were doing, Mr. Martin, is to go back and read the question exactly. What the examiner says, that the partners have requested you to write a comprehensive legal opinion on the instances in which the courts may decree a dissolution of a partnership, taking into account to discuss their unique circumstances in each case. So that if you focus on the answer, you have identified the legal provision under section 44 of the Partnership Act, and then you go ahead to tell the examiner the factors or the grounds that the court will consider. We have seen incapacity of a partner, conduct prejudicial to the partnership, breach of the partnership agreement, fraud, misrepresentation or non-disclosure, illegality, losses and prospects of profitability, any other appropriate ground, and we have even identified the various grounds that are applicable in the factual matrix, and with that you will be able to score the total 5 marks to the maximum.
Okay.
So that is well structured.
I'll go for the question. If you go up, if you go to the question itself again, kindly. Exactly, yeah. Now, if you look at this question, there's a part I wanted to get clear. The partners have requested you to write a comprehensive legal opinion on the instances in which the courts may declare a dissolution of a partnership, taking into account to discuss their unique circumstances in the case. Oh, sorry, it's okay, it's all right. I believe section 44 adequately captures that, as you've detailed it.
Thank you so much. And you have also seen the situation where I've not only given factors, because the question tells you to discuss the unique circumstances in each case. So in each ground, you test the circumstances that is applicable to Brande and Fela. And Pia, you have also noted that I have not focused on the format of a legal opinion, because we saw the best student anaanza kufocus na essentials of a legal opinion, and the examiner just does a cross and goes directly to the marking point. Remember, this is not LWD. They are interested in the answer that you want to give out directly. So that's why we have omitted it deliberately.
It is okay.
Okay. Question 4 was a good one, because question 4 tested on mergers and acquisitions. So we'll read it out, then we'll do a refresher of our previous sessions to see whether we mastered the same. So question 4, Raha Entertainment and Jamii TV have been in talks to streamline their respective businesses. Raha Entertainment operates a widely watched TV station focused on family entertainment. Raha is also a new entrant into the TV streaming business and is in the market for content to populate said streaming service dubbed Raha One. Jamii TV, on the other hand, has a vast library of locally produced content, but has in recent years favored the production and airing of more mature programming and is seeking to do away with its library of children content. As a result, Jamii found a willing partner in Raha to purchase its star animated children's program, The Zola and Woody Show, together with its offshoots, The Zola and Woody Magic Show and Zola and Woody in the Jungle. Jamii considers the children's show as a valuable piece of its intellectual property portfolio, as they have been able to monetize the said characters by selling t-shirts, toys and books related to the show's characters. Raha is aware that adding the show to their content library may prove advantageous to the streaming business model, which is a pay-per-view service set to be launched soon. Raha's assets or turnover, whichever is higher, does not exceed USD 3 million, while Jamii's threshold is USD 1 million. Raha is only interested in acquiring the One TV program from Jamii. So read out the brief questions, then we revisit in a way that we will all understand. Raha's CEO has been in talks with Raha's board and other advisors and has been informed that the proposed merger may be notifiable. briefly explain to Raha the three categories of mergers relevant to this fact in terms of the Competition Authority of Kenya, CAK, threshold guidelines, and where Raha's proposed merger will fall. 4 marks. B. You are further informed that Jamii prefers an outright sale of its Zola and Udi property versus a shares acquisition by the acquirer. With the foregoing in mind, highlight 4 important areas to be targeted at the due diligence stage of this transaction. Assume that you act for the acquirer. Then C. In terms of the asset purchase, Raha's CEOs makes it very clear to you that his company is very keen on 2 considerations with respect to the asset purchase: selective acquisition and liability control. Analyze these 2 concepts vis-a-vis the company's vision as highlighted in the fact pattern. So let us revisit the question in a way that we will clearly understand. We have 2 TV stations. We have Raha Entertainment and Jamii TV. They have been in talks on how they want to streamline their businesses. And now Raha Entertainment, it is reported to operate a widely watched TV station that is focused on family entertainment. And Raha Entertainment is also, and Raha, sorry, not Raha Entertainment. Raha is also a new entrant into the TV streaming business and is in the market for content to populate said streaming service dubbed Raha One. And Jamii TV, on the other hand, has a vast library of locally produced content, but has in recent years favored the production and airing of more mature programming, and now is seeking to do away with its library of children content. So we have 2 businesses. As a result, Jamii found a willing partner in Raha to purchase its star animated children's program known as the Zola and Udi Show together with its offshoots, the Zola and Udi Magic Show and Zola and Udi in the Jungle. So Jamii considers the children's show as a valuable piece of its intellectual property portfolio, as they have been able to monetize the said characters by selling t-shirts, toys, and books related to the show's characters. Raha is aware that adding the show to their content library may prove advantageous to the streaming business model, which is a pay-per-view service. So, of key importance is where the examiner tells you that Raha's asset or turnover, whichever is higher, does not exceed USD 3 million, while Jamii's threshold is USD 1 million, and Raha is only interested in acquiring the one TV program from Jamii. So to try out question A, Raha's CEO has been in talks with Raha's board and other advisors, and he has been informed that the proposed merger may be notifiable. Briefly explain to Raha the 3 categories of merger relevant to the facts in terms of the Competition Authority of Kenya's CAK threshold guidelines and where Raha proposed merger will fall. Mr. Martin, are you well versed on mergers and acquisitions, and what exactly is the examiner requiring?
I think we had a revisit. I remember when doing the traffic light with you and Arnold, for the notification of any mergers and acquisition, and we were talking about the threshold. Anything below 500 million, you don't need to do any notification. All right, you notify, but you don't get what we're calling it notification. What is you notify, but when you have the total asset and the total asset and all the turnover, the combined, then if it is between 500 and a billion, then you must notify. Notification is not optional; it's a must that you need to notify. And above 10 billion, then you must notify, and at the same time you must get an approval from CAK. So I guess those are the thresholds that you need to be able to look at here. But now, given that their asset, the value of the asset is, you've talked about 3 million. Yeah, it's 3 million. Yeah, 3 million USD and 1 million. Okay, fine. Yeah, I think we can be able to agree for those points. But let's see what you have.
So thank you, Mr. Martin. Mine is to also do a quick recap to understand exactly on the thresholds so that we see. So COMESA, Competition Commission, the combined turnover or assets of the parties in the COMESA region is 50 million USD or more. Each of at least two parties has turnover or assets in the COMESA region of 10 USD million or more. The parties do not achieve more than 2/3 of their COMESA-wide turnover in one member single state, and at least one of the merging parties operate in two or more COMESA member states. A party is considered to operate in a member state if it has a turnover or assets of more than 5 million in that country, 5 million USD. Now let us say for CAK, we see whether we did the same. This merger notification and thresholds. So merger notification is mandatory for qualifying transactions. If parties fail to notify, the merger is legally null and void pursuant to Section 42, and parties may face criminal fines, imprisonment up to 5 years, and administration penalties of up to 10% of annual turnover. Notifiable mergers, full notification required. A merger must be notified to CAK if the combined turnover or assets in Kenya is greater than or equal to Kenya shillings 1 billion, and the target's turnover or assets is greater than or equal to 500 million. Acquirer's turnover is greater than or equal to Kenya shillings 10 billion, and the entities operate in the same market or vertical chain. Mergers in carbon-based mineral sectors where asset value exceeds Kenya shillings 10 billion. If a merger meets commercial thresholds and is greater than or equal to 2/3 of assets or turnover are based in Kenya. Notifiable but excludable mergers. Entities may apply for exclusion from notification if the combined turnover or assets are between 500 million and Kenya shillings 1 billion. Merging entities are prospecting in the carbon-based mineral sector regardless of asset value. So that is where you will notify, but you are excludable. So you apply for exclusion, and excluded mergers exempt from notification. This is where combined turnover or assets is less than 500 million. So you are exempt from notification. And COMESA notified mergers where less than 2/3 of turnover or assets are in Kenya. So this is where we told the participants there's no need to cram those assets. You can come with a traffic light, and this traffic light will greatly help you. So you only need three numbers in your head: 500 million, 1 billion, and 10 billion, and you treat them like speed limits. We started with color green. If the combined Kenya turnover or assets is below 500 million, green, color green, so you are excluded. And we gave an example. There are two small local traders merging, and the combined Kenya turnover is 320 million. So automatically, no CAK notification. It's a green light. You can continue with your merging. Company structure changes within the same corporate group, but the controlling owner remains the same. Usually excluded because you're dealing within the same corporate group. Now that was just an additional, but let us stick to the numbers. That was color green. Then we moved to amber. So this is notifiable but excludable. You ask CAK to exclude you. If the combined Kenya turnover or assets is between Kenya shillings 500 to 1 billion Kenya shillings, it is amber, meaning you don't do full notification, but you apply for an exclusion. We give an example where the target turnover is 420 million and acquirer is Kenya shillings 300 million. If you combine the two, inakuja 720 million. So, amber, apply for exclusion. Don't assume you can ignore CAK. And there is a special amber trigger that has been listed in what we read before. Carbon-based mineral sector prospecting, regardless of value, will need to apply to be excluded. We even went ahead to give another example. There are two exploration companies with low current turnover but valuable prospects want to combine licenses. So still apply for exclusion because the sector is treated as sensitive. So that is an exception to the rule. Then we finished up with color red. Anything that hits the big test goes red. Your red test memories are partners, not wording. So we focus on the following. If the combined turnover is above Kenya shillings 1 billion and the target is Kenya shillings 500 million and above, this requires full notification. And to give an example, where acquirer Kenya turnover is 3 billion and the target Kenya turnover is 700 million. So the combined give us 3.7 billion. So look at how the target company is allowed to be more than 500 million, while the acquiring entity is allowed to have more than 1 billion. So that if you combine, you notify the CAK fully because you have already met the above 1 billion criteria. So we went deeper again to color red. So acquirer has more than 10 billion and the parties are competitors or in the same supply chain, you still need to notify. An example is where a large cement manufacturer who is worth 10 billion plus buys a quarry operator and to input to cement. Even if the target is not huge, CAK wants to review because the buyer is the dominant, so you require full notification. Another criteria that we saw is carbon-based minerals big value test. Carbon-based mineral sector with assets value of more than Kenya shillings 10 billion, you still need to notify. A coal or mineral asset acquisition valued at 15 billion will require a full notification to CAK. So now, what is the COMESA Kenyan Nexus test? How do you link between the two? If it meets COMESA thresholds and more than two-thirds of turnover or assets are in Kenya, you need to notify Kenya because CAK will be involved. So an example is a COMESA notified merger where most sales or assets are actually in Kenya, e.g. 75%. This isn't just COMESA. Kenya filing is also triggered and you will be required to approach CAK. So the 60-second checklist with no cramming, is this a controlling changing deal? If no, it is likely to be excluded. What's the combined Kenyan turnover or assets? Is it below 500 million? Then you are excluded. It's a green light. Is it between 500 million and 1 billion? So color amber. You apply for exclusion. Is it going more than 1 billion? Go to step number 3. Step number 3. Is the target company more than 500 million? If yes, you need to notify. Is the acquirer greater than 10 billion and same or vertical market? If yes, color red, notify. Is it carbon-based minerals? Prospecting any value, you apply amber for exclusion. Is it greater than 10 billion? You need to notify. Is it COMESA sized? If below 2/3 in Kenya, it is excluded. If it is greater than 2/3, our assets are based in Kenya, you have to notify CAK. So, Mr. Martin, that was the overview of what we discussed last time. Then, if we go now to the market scheme, we will appreciate because we now have the theory behind our answer. So, in the examination, you are told, briefly explain to Raha the 3 categories of mergers relevant to this fact in terms of the CAK's threshold guidelines and where Raha proposed merger will fall. Question 4a. Although Raha proposes to acquire only one program rather than Jamii TV itself, the acquisition may amount to a merger under Section 41 of the Competition Act 2010 if the program, associated intellectual property, merchandising rights and goodwill constitute a distinct part of Jamii's business and the acquisition gives Raha direct or indirect control over that business or asset. Under the Competition General Rules of 2019 and CAK's merger threshold framework, mergers fall into 3 relevant categories. 1. Merger requiring mandatory notification. A merger is ordinarily notifiable where the parties' combined turnover or assets in Kenya, whichever is higher, is at least 1 billion and the turnover or assets in Kenya of the target undertaking exceed 500 million. Such a transaction must be notified to and approved by CAK before implementation. Premature implementation may constitute unlawful gun jumping. So, we have mergers requiring mandatory notification. And in particular, where the combined turnover or assets in Kenya is, whichever is higher, is at least 1 billion, and the turnover or assets in Kenya of the target undertaking exceed 500 million. So in total 1.5, you apply for mandatory notification. Now, the second category is mergers requiring notification but eligible for exclusion. So this category generally covers transactions where the parties' combined turnover or assets in Kenya are between 500 million and 1 billion, or transactions involving carbon-based mineral sectors meeting the applicable threshold, or undertakings operating in COMESA whose combined turnover or assets do not exceed 500 million. So the parties must approach CAK and seek exclusion from the ordinary merger and file notification requirements. They should not simply assume that no filing will be required. Then the last category is transactions not requiring notification. Transactions falling below the applicable thresholds are generally not notifiable. This includes transactions where the parties' combined turnover or assets in Kenya are below 500 million, subject to CAK's power to require notification where competition concerns arise. An acquisition that amounts merely to an ordinary cause, non-exclusive license, and does not transfer control of a business or strategic asset may also fall outside the statutory concept of a merger. So what is the application to Raha and Jamii? Raha's assets or turnover do not exceed USD 3 million, while Jamii's do not exceed USD 1 million. Their combined figure is therefore no more than USD 4 million, which at prevailing exchange rate is approximately 500 million or slightly above it. Accordingly, if the relevant Kenyan turnover or assets are below the Kenya shillings 500 million, the transaction falls into the non-notifiable category. If they are between 500 million and 1 billion, it falls within the category for which the business should apply to CAK for exclusion. And it is unlikely to fall within the fully notifiable category because Jamii's stated USD 1 million figure is well below 500 million as the target threshold. Hapa sasa let me revisit the last statement because it is very powerful. It is unlikely to fall within the fully notifiable category because the target entity has stated it has USD 1 million figure. This is well below the 500 million target threshold, and we saw the acquiring entity should have 1 billion plus, and the target should have more than 500 million for us to have a full notifiable merger. So already point number C is a green light to you to tell you this transaction is unlikely to fall within the fully notifiable category because it has not yet met the minimum subscribed to each individual. And the exact classification cannot safely be determined merely by converting the stated USD figures. Raha should establish the parties' audited Kenyan turnover and asset values, apply the proper exchange rate for the relevant financial year, and determine whether the acquisition gives Raha control over the program as a separable business asset. If Raha receives an exclusive and permanent assignment of the program, characters, copyright, offshoots, and merchandising rights, the transaction is more likely to constitute an asset acquisition capable of being a merger. A limited, non-exclusive content license is less likely to amount to a merger. Raha should therefore obtain CAK's written guidance or apply for exclusion before completing the acquisition if the combined Kenyan figures meet or marginally exceed 500 million. So the last steps ni just additional information because we have already answered the question, we have already given the application to the facts, we have converted the total amounts involved, and we have even advised the client. So in that situation, and now we'll have scored the full 4 marks. Mr. Martin, is that in order? Good. So, B. You are further informed You are further informed that Jamii prefers an outright sale of its Zola and Udi property versus a shares acquisition by the acquirer. With the foregoing in mind, highlight 4 important areas to be targeted at the due diligence stage of this transaction. Assume that you act for the acquirer. Now, the examiner is testing your ability to know the due diligence stages and important areas that you need to target during the due diligence stage. Assume that now you are acting for the acquirer because you have been informed that Jamii prefers an outright sale of its Zola and UD property versus a shares acquisition by the acquirer. What is the examiner really testing so that they can give you the 4 marks? What happens at the due diligence? What are the important areas to consider?
I guess for this question, what we need to be able to do is to give out details of the various due diligences that need to be conducted by the acquirer so that they are comfortable. So I think one of the things that you have to be able to look at is because this is an IP, we have to be able to do a legal due diligence so that we are able to get to know whether this has been registered with KIPI and what's the status of that intellectual property, and also the other aspect of the business in terms of the trading licenses and all that, yeah, and whether there are any suits, there are any claims that are likely to be put in the suits for the items that are being merchandised. Then the other one is to do a commercial, financial, just to be able to look at financial due diligence, just to be able to look at how profitable the books are and all that, and looking at this what is the commercial, the what do you call this, the profit and loss account relating to this institution. Then of course the other due diligence that needs to happen is on the operations, just to be able to understand how the business model that they have used to be able to commercialize. So I guess those are some of the things that probably I'll be able to look at, including the commercial, just to be able to understand the market where they are selling this merchandise.
Thank you so much. So let us put your answers against the marking scheme. Diligence areas for us an acquirer. So because Jamii proposes an asset sale rather than a share sale, the due diligence should establish precisely what constitutes the Zola and Udi. Oh, sorry. Thank you. So I was saying, let us put now your answer against the marking scheme. And the due diligence areas for us as an acquirer will be, because Jamii proposes an asset sale rather than a share sale, the due diligence should establish precisely what constitutes the Zola and Udi property, whether Jamii owns it and whether it can validly transfer to it. So the 4 principal areas are: look at the ownership and chain of title, and you have correctly captured the same. Confirm that Jamii owns all relevant intellectual property rights, including copyright in programs, script, animation, artwork, music and recordings, rights in the characters, titles and logos, registered and unregistered trademarks, merchandising rights in toys, books and clothing, rights in the spin-offs, and domain names and social media accounts. So you review employee and independent contractor agreements, assignments from writers, animators, composers, actors and producers, and any recordals or registrations at Kesobo and KIPI. Identify joint owners, retained moral rights, and any dispute over authorship. So the first point was confirmation of ownership and chain of title. Then second due diligence is on encumbrance, licenses, and third-party rights. So search for and review any charges or security rights registered under the MPSR regime, existing broadcasting, streaming, distribution, publishing, or merchandising licenses, exclusivity, territorial or platform restrictions, royalties, collecting society obligations, and revenue sharing arrangements and options, preemption rights, or consents required before assignment. So that is step number 2 on due diligence on encumbrance, license, and third-party rights. RAHA should ensure that it receives the rights free from undisclosed encumbrance and that existing licenses will not prevent use of the RAHA One pay-per-view platform. The other due diligence, you check the scope, validity, and commercial exploitation of the IP. So you verify the substance, validity, duration, and territorial reach of every right. Determine whether the proposed transfer includes all existing episodes, raw footage and production materials, sequels, adaptation, remakes and future productions, streaming and pay-per-view rights, advertising and proportional rights, merchandising and publishing rights, and past and future receivable. So review historical income, audience data, merchandise sale, license agreements, and royalty statements to verify Jamie's claims concerning the property's commercial value. So that was the third point on scope, validity, and commercial exploitation of the IP. The fourth due diligence, as you capture the same, is on litigation, regulatory, and contractual compliance. Investigate existing or threatened claims involving infringement, plagiarism, royalties, defamation, privacy, child protection, or contractual breaches. Confirm that music, images, and other third-party material have been properly cleared. Review compliance with broadcasting, content classification, consumer protection, advertising, and data protection requirements. RAHA should establish whether the transaction constitutes an acquisition of control over a business asset requiring CAK notification or exclusion. Identify all regulatory or contractual approvals required before completion. So, as a quick recap, you have been told to do a due diligence, and the examiner told you directly they are not focusing on share sale, they are rather focusing on asset sale. So your due diligence should also align to a due diligence on an asset sale. So you've confirmed the ownership and chain of title of those assets. You confirm whether there are any encumbrance, licenses, and third-party rights, because we were told copyright, IP rights are part of assets and can form part of the MPSR regime, and this is commercial transactions. So the examiner is also expecting to see whether you can conduct a search in the MPSR search engine. So you check on encumbrances, licenses, and third-party rights. Then point number 3 is what is the scope, validity, and commercial exploitation of the IP that is currently held. Will it allow your objectives to do the pay-per-view right? So you check the scope, validity, and commercial exploitation. Then you check litigation. Remember, there can be lawsuits on plagiarism, royalties, even defamation. So you do a litigation check, regulatory and contractual compliance in both institutions, both judiciary and even in the music industry, etc. So basically, we have answered that question the way the examiner expected us to approach it. So, Mr. Martin, I know you have been shocked on the change of trajectory, because it is giving us a concentrated angle of looking at it, not rather a general perspective. So the third question was a bit technical in my view. In terms of the asset purchase, RAHA's CEOs make it very clear to you that his company is very keen on two considerations with respect to the asset purchase. So they are very keen on two considerations. One, selective acquisition and liability control. Analyze these two concepts vis-a-vis the company visions as highlighted in the fact pattern. So I'll also project the fact pattern so that you can try as much as possible to get, because it is 2 marks. What exactly do you mean by selective acquisition and liability control vis-a-vis the company's vision? So the concept is selective acquisition and liability control. This is the factual matrix. What is selective acquisition? And what is liability control? What is the examiner really testing on such a question?
Are we supposed to differentiate the two? Or from what I'm seeing, it's like it appears to be. I'll just just trying to imagine selective acquisition is where you Like for this case, you see they have just picked up on the specific product line that they are picking up. So I want to believe that is what would be a selective. You're not taking the entire company. You're just picking maybe a product line, buying off a product line from them. Yeah? Whereas the liability control, I'm trying to imagine it from the angle, from the general meaning of it, that you want to.
Mr. Martin, there is an alarm
Oh,
that is sound.
oh yes, yes. Off now. Yes, so for the limited liability, I think what they want to be able to, I think for limited liability control, they tell it to mean that you maybe want to assess the model of the business that you want to be able to acquire and look at what kind of liabilities are you likely to bear from that business model. So you want to make sure that those liabilities are as limited as possible. They're not much. You're able to have control over them. Like for example, if there were suits pending on the copyright, for example, then you're able to, I don't know, I think then you're able to look at what are the liabilities that come with that business. I want to imagine that.
Thank you, Mr. Martin. Because the question carries 2 marks, I believe you are well on track because it was testing the general aspect of your mastery of the factual matrix. And this is what is happening. On selective acquisition, an asset purchase allows Raha to acquire only the assets necessary for its commercial objective rather than shares in Jamii TV or Jamii's entire IP portfolio. So the agreement should therefore precisely identify the acquired assets, including the Zola and Yudi show and its 2 spin-offs, copyright in the episode, script, animation and recordings, character, title, trademark rights, streaming, pay-per-view, adaptation and distribution rights, merchandising rights relating to toys, books and t-shirts, relevant contracts, digital accounts and production materials, and goodwill. So Raha may exclude Jamii's mature programming and related content, other assets and unwanted contracts. This supports Raha's family entertainment focus and supplies targeted content for the Raha One platform. So identify how we have answered the same. We have given the general overview like Mr. Martin you have given. We have even identified the exactly and precise requirement that should go in the selective acquisition, and then we have finished off with saying the unwanted, the excluded Jamii's mature programming content because it is unrelated. Then on liability control, unlike a share acquisition, where Raha will acquire the company with its historical liabilities, an asset purchase generally enables it to assume only liabilities expressly identified in the agreement. So Jamii should retain all excluded. Oh, I thought I had muted. So Jamii should retain all excluded liabilities, particularly pre-completion infringement and royalty claims, employee and contractor claims, debt, taxes and security interest, litigation concerning the programs, breaches of existing broadcasting, licensing or merchandising contracts, and regulatory non-compliance arising before completion. So you have been told that unlike share acquisition, where Raha will acquire the company with its historical liabilities, an asset purchase generally enables it to assume only liabilities expressly identified in the agreement. This is the reason why we did a legal, a litigation search to confirm whether we will be bound by various liabilities or not. So that is the essence. So the agreement should contain clear, assumed and excluded liability clauses, warranties on ownership and non-infringement, indemnities, disclosure obligations, and where appropriate, an escrow or retention. However, contractual exclusion does not automatically defeat liabilities imposed by statute or third-party rights, and existing secured interest or licenses must be discharged, assigned, or appropriately addressed before completion. Question 5 is now another question. I'll read out, then briefly we will discuss. So Francis, the director of Tag Masters Limited, has decided to sell his residential property where he has lived for the last 7 years. The reason for this sale is to offset a bank loan and downsize to a smaller property now that his children have left the nest. His friend Joe, who runs a Group of Schools Limited, has agreed to buy the property through his company Group of Schools Limited. The sale price of the residence is Kenya shillings 50 million. Citing the relevant statutory provisions, advise Francis on whether he is liable for any tax payment should the transaction proceed. So this question now tests on tax payments. Rustic Acres Limited would like to sell 49 acres of land for the price of 1 billion. Your client Crafty is the director of Rustic Acres Limited, and Rustic Acres Limited intends to sell the aforementioned property to Shrewd. Both Crafty and Shrewd agree that they will want the transaction structured in such a manner that they pay the least amount of tax possible. With this in mind, Crafty suggests that the only way to avoid high taxation will be to create a subsidiary company, Weedflower Limited, in which Rustic Acres Limited will own 90% of the shares and transfer the land that is subject of the sale to Wildflower Limited. Once the transfer of the land to Wildflower Limited is complete, Wildflower Limited can then allot shares to Shrewd that will be equal to the value of the land. As such, both Rustic Acres Limited and Shrewd will pay minimal taxes. 1. If the transaction is structured as aforementioned, both Rustic Acres and Shrewd will pay minimal taxes in comparison to a direct sale. True or false? 2. Giving reasons, explain whether this will be a valid transaction. 6 marks. So let us revisit the question so that we appreciate. We have a person known as Francis, and he is a director of one company known as Tag Masters Limited. And this director, Mr. Francis, may decide to sell his residential property yenye amekaa for more than 7 years because his children wametoka from his home. Now, his friend who runs Group of Schools Limited has agreed to buy the property through his company Group of Schools. So ananunua through his company Group of Schools. And the sale price of the residence is Kenya shillings 50 million. So citing the relevant statutory provisions, advise Francis on whether he is liable for any tax payment should the transaction proceed. So generally, what kind of a tax is Mr. Francis eligible to pay over such property?
I guess the first one is the capital gains, irrespective, and the stamp duty. So those two taxes are the taxes that I think the examiner is looking at: the capital gains and the stamp duty.
Thank you. Do you have relevant statutory provision, because the examiner is also expecting to say?
I don't have it in my mind, but I know it's. Yeah, okay. I don't have it.
Thank you. So let us see. Yes, Mr. Brian?
It's okay, you can proceed.
Oh, maybe you can also speak out. Maybe I have not yet proposed the whole marking scheme.
Now that we consider my addition would be he would be exempt from CGT. You see, it's private residence. Even though we are told that he is the director of Tagmasters Limited, nor is it is told that he's a private residence. So our assumption that being a private residence, then it is exempt. Exempt mean we're basing our exemption on it not being a commercial. It's a private residence, so it is exempt from CGT.
Okay, thank you, Ringera. So let us see from the marking scheme. So Francis will principally be concerned with capital gains tax and stamp duty, as Mr. Martin has captured. Capital gains tax, ordinarily, a gain arising from the transfer of property situated in Kenya is taxable under Section 32F as read with the 8th schedule to the Income Tax Act. So CGT is imposed on the net gain rather than the full Kenya shillings 50 million purchase price. So the enabling provisions is Section 32F as read with 8th schedule to the Income Tax Act. However, the 8th schedule exempts a gain arising from the transfer of a private residence where the individual owner has occupied it continuously for the prescribed period immediately before transfer. Francis has occupied the property as his residence for 7 years, provided it was genuinely his private residence and he satisfies the statutory conditions. The gain should be exempt from CGT. The fact that Francis is a director of Tag Masters Limited is immaterial if the property is registered in his personal name and was used in his private residence. Likewise, his intention to apply the proceeds toward a bank loan does not create CGT liability. So what we have seen is that Mr. Martin, you took a general overview, but because Ringera has practiced this thing and has even read the 8th schedule, he was quick to identify an exemption. So the marking point was the exemption and not the general view of the CGT. Now, on stamp duty, under the Stamp Duty Act, the stamp duty on transfer is ordinarily payable by the purchaser or transferee, Group of Schools Limited, rather than Francis. Francis should nevertheless provide the transfer documents and cooperate with valuation and stamping before registration. And the conclusion is that Francis should not incur CGT if he proves that the property was his qualifying private residence for the relevant period. He should retain the title, utility bills, identification records, and other evidence of continuous occupation. Group of Schools Limited will ordinarily bear stamp duty on the transfer. Any outstanding land rent, bank discharge costs, and contractual transaction expenses must be dealt with separately, as they are not taxes on Francis' capital gain. So Ringera could have ended up scoring 2 marks because of the legal backings and provisions, and Mr. Martin could have ended up scoring 1 mark because of the stamp duty answer. So the other question reads that we saw Rustic Acres Limited willing to sell 49 acres of land for the price of 1 billion. And now your client is known as Crafty, is a director of that company, Rustic Acres Limited. And now this Rustic Acres Limited intends to sell the aforementioned property to one person known as Shrewd. So both Crafty and Shrewd agree that they will want the transaction structured in such a manner that they pay the least amount of tax possible. Okay, so with this in mind, Crafty suggests that the only way to avoid high taxation will be to create a subsidiary company known as Wildflower Limited, in which Rustic Acres Limited will own 90% of the shares and transfer the land that is subject of the sale to Wildflower Limited. Once the transfer of the land to Wildflower Limited is complete, Wildflower Limited can then allot shares to Shrewd that will be equal to the value of the land. As such, both Rustic Acres Limited and Shrewd would pay minimal taxes. Then the question reads, if the transaction is structured as aforementioned, both Rustic Acres and Shrewd will pay minimal taxes in comparison to a direct sale. True or false? 1 mark. Then 2. Giving reasons. Explain whether this will be a valid transaction. So when you answer, you first start by telling us, is it true or false? Then you give us reasons, explaining whether this kind of a transaction is a valid one. What is the concept that the examiner is testing? Tax. Okay. Yes, Mr. Brian.
Give us a minute here. There's something here.
As Brian comes on, I think the way they have structured it, it will be able to give them. It's true that they will be able to pay minimal taxes because of how they by forming this SBU. Because they'll only be transferring the shares there, so I want to believe that could be the case. Let's hear what Brian has to say.
As you wait for Mr. Brian, is that kind of a transaction valid?
I believe it is valid. It is valid. What do you think?
Okay, I'll also say it is valid. And what do you think on tax avoidance versus tax evasion. Which one is illegal? Which one is legal?
I think tax evasion, tax avoidance. I think they all amount to the same thing because KRA wants to be able to make its money. But I'm not too sure. But let's hear what others have to say about this.
Did you do Nini? Tax law?
We covered it, but very briefly. I want to believe that we will be able to cover it now in this that term. Remember that visiting lecturer? Yeah, so.
I also meant in LLB level.
Oh, okay.
So tax law was one of the electives, and I did that, and even did my dissertation on tax law because I have a special interest on tax matters. I see tax law being one of the most lucrative areas in the near future because of how KRA is doing its things now and then, new taxes. So it is bringing everyone from the informal sector. In fact, my dissertation was bringing the informal sector to the KRA tax bracket. I analyzed the challenges and the good prospects arising from that kind of a movement. So, yes, Mr. Brian.
Let me have my take. So, Rustic Cars Limited is looking to sell land. That is the key point. Then the fact pattern shifts very fast to creation of a subsidiary company and allotment of shares to Shriud later when this land is transferred to this subsidiary company. So what arises here is a scheme by Rustic Cars Limited. Victor, you've mentioned either tax avoidance or tax evasion, right?
Yes.
For this one, I would characterize it as a tax avoidance scheme, in which the registrar, in this case, it is the registrar of taxes, the Kenya Revenue Authority. The registrar would identify this scheme. So my answer to the first question is false. So the question reads, if the transaction is structured as aforementioned, both Rustic Acres Limited and Shriud would pay minimal taxes in comparison to a direct sale. True or false? My answer would be false. You see, when you're registered in a company, so first of all, these background, these are the background. So I've already answered the question, but these are other background that I will not include in the answer, but I would like just to explore. When you're registering a company, there's the cap of 5 million Kenya shillings, where if your company is worth less than 5 million Kenya shillings, then you're exempt from stamp duty. But if you're registering a company whose nominal share capital is more than 5 million Kenya shillings, then you are liable to pay taxes on the shares that you are registering in this company. Then here you can see in which Rustic Acres Limited would own 90% of the shares and transfer the land, which is the subject, to the sale to Willflower Limited. So essentially, even this transfer, this second transfer that is here, this first transfer that is even before we get to Shriud, this one here, Rustic Acres Limited to Wildflower Limited, it doesn't matter whether or not it is a subsidiary of Rustic, it is still a share transfer, it is still a sale. So they would still have to pay taxes on these 1 billion Kenya shillings. You see? Then let me attempt the second question. Explain whether this would be a valid transaction. I would not give it an express yes or no answer, but I will rely still on tax avoidance. So I would not exploit in the manner of a penalization for either of the companies, but I will just explore what is tax avoidance. I would say that the registrar would like to classify this as a tax avoidance scheme but not classify it somewhere on paper or expressly. No, they would just have to raise these issues. They would raise these improper these assumptions. Essentially, the registrar would raise these assumptions on you. So the registrar would still ensure that the taxes that are supposed to be paid, especially when Rustic Acres Limited is transferring to Wildflower, are paid. Secondly, depending on the value of Wildflower Limited, when allotting shares to Shrewd, that would be equal to the value of the land. When transferring shares, now I've moved from now Rustic and Wildflower. So for my answer for Rustic and Wildflower is it is a tax avoidance scheme. So still they would still have to pay they would still have to pay the taxes relating to the transfer of the land from Rustic to Wildflower, one being stamp duty that would be paid by the purchaser, who is Wildflower in this case. Second, they would have to pay, that is Rustic Acres Limited would have to pay for let me hold on tax on CGT there. Let me hold on CGT there, because there are some exemptions that have been introduced this year on internal transfers. Let me now proceed. I will just leave that hanging. Then let me proceed very fast to the allotment of shares between Wildflower Limited and Shrewd. That would be equal to the value of the land. There are three types of transfers. First of all, you can transfer shares. Now, these shares, these allotment transfer, they are not the same thing. But let's even just go with the allotment that we've been given here. So there are three types of allotments. So I can allot to you shares, one at a discount. So if the shares are worth 20 shillings, we discount the value and I say I sold the shares to you at 10 shillings. It is allowed. A discount would also mean things like natural love and affection, things like a gift. I gift you the land, I gift you the shares. No, not the land, sorry. I give you the shares. So that is what the discount involves. There is allotment at par value. So if shares in Wildflower Limited are worth 20 shillings, then it would mean that we are transferring them at that exact 20 shillings. But we are not told either discount or par value. Par value being PAR. We are told about premium, because the value of the land is 1 billion. So we are talking about a premium. You see? So when you talk about a premium, then all other taxes that are applicable to this premium are there. And for here, I will impose CGT on Wildflower Limited. I will impose no. Wait a minute. Yes, I will impose not capital gains tax. Let me first withdraw capital gains tax. I will impose stamp duty on Shrewd. I will impose on CGT. I'm still stuck even on this second transaction. Thank you.
So thank you, Mr. Ringera, and you appeared to be a guru when it comes to matters on commercial litigation. Now, this is a direct question. Between tax avoidance and tax exemption, which one is legal and which one is illegal?
Tax avoidance and tax evasion.
Yes.
Which one is illegal? Which one is legal? I failed to draw the line.
Okay. Then the second criteria. Do you know what is a transfer mispricing? A transfer mispricing. Did you read it anywhere? Where a company opens a subsidiary, then tries to evade tax using a subsidiary. And there is a landmark decision known as the Unilever decision, where Unilever opened a branch in Uganda, and Unilever, the same Unilever, had operations in Kenya. So it was discussed in that decision that they are engaging in what we call transfer mispricing, because KRA individuals had to summon them, and the KRA commissioner told them that they are engaging in transfer mispricing. So in tax matters, you should be very detailed in your answer, because question Roman 2 is asking you, is this a valid transaction? So you have already identified that these are tax avoidance, and tax avoidance is where you are legally using legal means to pay minimal taxes or even avoid tax because you are using the legal provisions. But tax evasion is a crime. That's why KRA will summon you and tell you that you have evaded to pay taxes over a certain period. So let us see the marking scheme and appreciate exactly what is happening in this factual matrix. But we greatly appreciate your content. And Mr. Ingera, you are well equipped with knowledge. Yes, Brian?
For the legality and illegality, the line is a very thin one, and it is the discretion of the tax authority. You know, you cannot automatically legalize it or illegalize it based on any set of facts. Not until the registrar, now you as an advocate, you have been given now the power to become a tax, someone to analyze tax here. So you are now the tax registrar here. So you are the one to characterize each set of facts on whether they are a valid tax avoidance scheme or still an invalid tax avoidance scheme. You see, but for tax evasion is simply illegal.
Thank you, Ingera, for that trajectory. So let us see. Yes, Brian.
No, I'm done.
Okay, so let us now test your answers against the marking scheme so that we see and appreciate clearly what is happening in this kind of a question. So we will go straight in. Roman 2, validity of the proposed transaction. 1. Separate corporate personality does not make the transfer tax free. So Wildflower Limited will be a separate legal person from Rustic Acres Limited, even though Rustic initially owns 90% of its shares. Transfer of the land to Wildflower is therefore a disposal to another person, not merely an internal movement of property. So the transfer must comply with the Land Registration Act, the Land Act, the Companies Act, and any applicable consent requirements. You said something on CGT, then you said I'll not state that. So CGT, the transfer of the land by Rustic Acres to Wildflower, is ordinarily a disposal for purposes of the 8th schedule to the Income Tax Act. Any gain will be determined by reference to the transfer value, adjusted cost, and allowable expenses. Using shares rather than cash as consideration does not necessarily eliminate CGT. Where parties are related or the consideration does not reflect market value, the tax consequences may be determined by reference to the property's market value. Third point is on stamp duty. The transfer of the land to Wildflower is ordinarily subject to stamp duty under the Stamp Duty Act, based on the value accepted following government valuation. Payment through shares rather than cash does not by itself exempt the pay conveyance from stamp duty. Relief under Section 95 of the Stamp Duty Act applies only to a genuine and qualifying reconstruction or amalgamation satisfying its statutory conditions. The proposed transfer of one parcel into a special purpose subsidiary to facilitate its sale to Shrewd is not automatically entitled to that relief. An application for adjudication and confirmation by the collector of stamp duties will be necessary. Marking point number 4 is allotment of shares does not achieve the proposed sale as prescribed. If Wildflower allots new shares to Shrewd, the consideration for those shares must ordinarily be provided to Wildflower, not to Rustic Acres. Further, the number and class of shares must be properly determined. Shares cannot simply be described as equal to the value of the land without an agreed valuation and corporate structure. So the allotment must be authorized, recorded in the Register of Members, and notified to the registrar under the Companies Act of 2015. If Shrewd is to obtain control, the percentage voting rights acquired, not merely the monetary value of the shares, must be specified. Marking point number 5, anti-avoidance and substance of a form. Under the Anti-Avoidance provisions of the Income Tax Act, KRA may adjust or disregard a transaction whose main purpose or effect is avoiding or reducing tax, especially where it is artificial, fictitious, or lacks genuine commercial substance. This aligns with Ringera's answer that it is not you to decide on a direct tax avoidance scheme, but it is upon the KRA to adjust or even disregard a transaction. So the stated objective is to place the land in Wildflower and then allot shares to Shrewd so as to avoid the tax arising on a direct Kenya shillings 1 billion land sale. The arrangement may therefore be treated in accordance with its commercial substance as an indirect disposal of the land. So penalties and restraints may arise if the parties fail to disclose and pay the correct tax. So tax planning is lawful, but tax evasion, sham transactions, and artificial arrangements intended to defeat tax legislations are not. Other approvals and taxes. The parties must also consider whether the land is agricultural land requiring LCB board consent under Section 6 of the Land Control Act, corporate approvals by Rustic Acres, Wildflower, and Shrewd, and whether the land is charged and therefore requires the lender's consent and discharge. Beneficial ownership disclosures is also required. So possible corporation tax, VAT, and withholding tax consequences depending on the nature of the land and transaction, and whether the acquisition is a notifiable merger under the Competition Act. So the conclusion is that the incorporation of Wildflower and a genuine transfer to it can be legally valid if all corporate, land registration, consent, and tax requirements are met. However, the structure does not automatically minimize tax and is especially vulnerable because its stated purpose is avoiding the tax payable on the Kenya shillings 1 billion sale. A direct sale may be legally and fiscally safer unless KRA confirms that a specific statutory restructuring relief applies. So, going back to the question, exactly what the examiner wanted is your ability to give reason and explain whether this will be a valid transaction. And this is where Ringera tells us we dissect this question to clearly identify various tax brackets, various exemptions, various principles, and even the internal arrangements of these companies. So, and in doing so, the question carries 6 marks. So the examiner is expecting to see what is your detailed appreciation. And we omitted question A. It is false. The answer is false. The structure does not automatically result in minimal tax. It creates at least 2 taxable dealings: the transfer of land from Rustic Acres Limited to Wildflower and the subsequent acquisition by Shrewd of an interest in Wildflower Limited. KRA may disregard or recharacterize the arrangement if its dominant purpose is avoidance of tax. So KRA will have to look through and say, let us reconsider this kind of arrangement because we can clearly see you are avoiding tax payment because we have 2 taxable dealings. There is a transfer of land. Then it is not only that, you are also intending to do a subsequent acquisition to Shrewd of an interest in Wildflower Limited. So this company Wildflower Limited is a shell to defeat purposes of taxation. So they can look over that, then the answer will now become false. And what you are saying false is that if the transaction is structured as aforementioned, both Rustic Acres Limited and Shrewd will pay minimal taxes in comparison to a direct sale. So if you are quick to say true, what will be your reasoning? Your reasoning will say generally kuna tax avoidance scheme, and without dissecting to see the veracity of the tax avoidance scheme as we have seen in this analysis. So that is done. On the second bit of it, whenever you're told to give reasons and explain whether a certain transaction will be valid, and the question carries 6 marks, so an examiner expects a detailed conversation. So we said, let us subject the examiner to see that we have mastered whatever is going on. So we noted that we have separate corporate personalities, and that is not an exception to transfer tax-free transactions. So that is well captured. We identified that. We also identified the issue on capital gain tax. So this is not a private property. Okay, there is a gain to be incurred in such transactions. So capital gains tax had to be captured. And stamp duty also appears to take effect because the identifier is using shares rather than cash as consideration does not eliminate CGT. So by the fact that you're not also inclining to the land sell angle of it, using shares on its own can also amount to CGT. And there is also a new decision. Niona Ringara pia you are well read about a landmark decision that says on internal something to do with internal transfer of shares nini nini. We'll also look over that, but niliona in a news article. So usitumie land pekee kusema CGT, look at also shares. We have also seen stamp duty, and stamp duty inakwambia pia there is a relief under section 95, and it will only apply to a genuine and qualifying reconstruction or amalgamation satisfying its statutory conditions. So take note to tell the examiner, you know there is a relief, but this is to be from a genuine adjudication. So you had applied for adjudication and confirmation, and if the same came out positively that you are eligible for this relief, automatically then you will be subjected to this relief. But if you are not eligible because the factual matrix never told us that they had done an application to the collector of stamp duties, automatically then they will be eligible to pay the stamp duty under the Stamp Duty Act by that virtue. Then another answer is allotment of shares does not achieve the proposed sale as described. And this is where Ringera was trying as much as possible to even tell us the various allotment schemes available. So if Wildflower allots new shares to Shrewd, the consideration for those shares must ordinarily be provided to Wildflower, not Rustic Acres. So further, the number and class of shares must be properly determined. Shares cannot simply be described as equal to the value of the land without an agreed valuation. So the allotment must be authorized, recorded in the register of members, notified to the registrar under the Companies Act. So all this is silent in the factual matrix, because what you can see is one of the director in Wildflower is willing to allot one share to Shrewd. So this on its own is not available, because allotment requires official preparations, even notification to the register under the Companies Act. So we were eligible, we were able to identify that kind of allotment being an illegal allotment. Then we also introduced another concept on anti-avoidance and substance over form. So the KRA people will have to look what is going on. Is it tax planning? And tax avoidance is one angle of using tax planning methods to pay minimal taxes. But what we can say clearly is that this must be evaluated by the KRA officials. It is not from your end directly to say that this is a tax avoidance, therefore you are justified. So allow KRA to do their work, then they will be the ones to say this amounts to a good tax avoidance scheme. So other approvals and taxes, we were able to tell the examiner that if the land is also dealing with agricultural land, then we will also require the LCB board consent. We will also require beneficial ownership disclosures to prevent the shell companies from avoiding taxes. And we have also noted about charge. If there is any charge, you cannot use a shell company to defeat the lender's consent, and discharge where required. And where acquisition is a notifiable merger under the Competition Act, we also saw this feature arising in such transaction. So that is exactly how the marking scheme reads. And remember, whenever you see 6 marks, also don't be mean with your answer. Talk as much as possible, because Ringera had something to say on CGT and later omitted the CGT aspect. But we are well impressed on how you were able to capture majority of the issues arising before us. I also captured the tax avoidance and tax evasion scheme to add into the picture. So thank you so much for answering part 5. And remember, we said we can't leave a question kama hatujamaliza. So automatically, either suo moto, we must answer question 6 in a brief manner. The time imekimbia. Sasa naona ni 5:39. So I'll be very brief and tell you exactly what examiner alikuwa anatafuta hapa, alafu tuko tumefunga the session. So Genga Microfinance Limited is a microfinance institution providing accessible financial services to the rural communities participating in the blue economy sector in Western Kenya. The approach of Genga Microfinance Limited is to obtain grants from developed partners and help local communities participate effectively in the blue economy sector. The interest in the sector has grown rapidly, and development partners have pumped in millions of shillings to support the sector. After operating for several years, a major audit of Genga Microfinance Limited revealed that the directors have been engaged in corruption. The development partners have threatened to stop their support to Genga Microfinance Limited unless the directors are removed. The notice for the motion to remove the directors has been duly served in advance pending the convening of a special meeting to pass a special resolution to this effect. Suma is one of the directors being targeted. He has approached the office to get advice on whether he has a right to protest against his removal. So advice. So this question is about removal of directors, and what do you have to say on maybe the procedure of removal of a director? What do you have to say? Let me rephrase the question in a way that you'll understand, and when you answer, you can even give reference to the factual matrix. So we have a company known as Genga Microfinance Limited. Its role is to offer loans, and the approach of Genga Microfinance Limited is to obtain grants from developed partners and help local communities participate effectively in the blue economy sector. So the interest in the sector has grown rapidly, and development partners have pumped in millions of shillings to support the same. After operating for several years, a major audit of Genga Microfinance Limited revealed that the directors have been engaged in corruption, and the development partners have threatened to stop their support to Genga Microfinance Limited. So the notice for the motion to remove the directors has been duly served in advance pending the convening of the special meeting to pass a special resolution to this effect. So Suma is one of the directors being targeted, and he has approached you as an advocate to get advice on whether he has a right to protest against his removal. So advice. What will you advise Mr. Suma? And the question still carries 6 marks, so it expects a detailed answer. Ringera?
I'm in a minute. I'm there. For companies, for governance in companies, yes, the Fair Administrative Action Act and Article 47 of the Constitution provide for fair administrative action. The right to protest, I'm lost on the right to protest, but I will assess the specific rights that are accrued to Suma. But I would not rely on the fair administrative action or the Article 47 of the Constitution, but I would rather rely on the Companies Act. I do not have the specific sections, but I would say that the first thing you issue a notice, so he has a right to notice, to be notified of this special meeting. You see, the other thing is I'm wondering, are we going to pass it under special resolution or ordinary resolution? Because it's the removal of a director. You see, so yes, we are giving him notice before the meeting. Then we will give him time to be heard. So, for example, he can make reports to the committee, and the committee being the board of directors in this case still. uh, particularly the development partners. Then we would have, he would still, so if he has a right to be heard, then he would address the meeting, he would then that's where his removal would be assessed. Then he would probably be his fate would be decided under an ordinary resolution of the shareholders. If they are if they are satisfied that they want to remove him, they will remove him, even if he objects. If they are satisfied that he is to stay, then he will stay. Then my final attempt would be on whether he had a service contract. Yes. So if he was to have a service contract, that would mean that it has been terminated by this ordinary resolution prior to its conclusion. Then he would be entitled to his dues under termination. But the protest and the protest would specifically not arise in the manner of him protesting and refusing to get out, because now this is a private company, or okay, let me not assume it's a private company, but it's a company limited. So it is entitled to its own rules of procedure. It is entitled to, as long as they are in compliance with the Companies Act. So my final clarification that I would seek is on the special resolution. A special resolution, because special resolutions are used in specific circumstances.
Maybe that is also one ground of protest as an advice to him. So, Mr. Martin, unless you have an input, I beg to look at the marking scheme. Okay, so you have no objection. So the advice to Suma is that Suma has a statutory right to protest and be heard, but he has no absolute right to remain a director if the members lawfully vote to remove him. That was captured by Mr. Ringera. So, advice number 1 is on resolution required for removal. Under Section 139(1) of the Companies Act 2015, a company may remove a director before the expiry of the director's term by an ordinary resolution passed at a meeting, notwithstanding anything contained in an agreement between the company and the director. So the provision is Section 139(1) of the Companies Act on an ordinary resolution as compared to a special one. Consequently, the proposed special resolution is unnecessary. An ordinary resolution with a simple majority of votes cast is sufficient. However, the resolution cannot be passed as a written resolution of a private company. Section 262(2)(a) requires it to be considered at a meeting. So if the factual matrix told you that there is a resolution that has been passed in written to remove a director and it is a private company, so take note next time that that is illegal because it requires compliance with Section 262(2)(a) of the Companies Act 2015 that requires it to be considered at a meeting. And the only time a written resolution will be allowed is for public companies. 2. Requirement for special notice. Although only an ordinary resolution is required, special notice of the proposed resolution must be given under Section 139(2). On receiving the notice, Genga Microfinance Limited must send a copy to Suma in accordance with Section 141(1). If the required special notice or meeting procedure has not been followed, Suma may challenge the removal and seek appropriate declaratory or injunctive relief. So there is a requirement for a special notice on the proposed resolution given under Section 139(2). So that was silent in the factual matrix. Or was he given a notice? So the notice for motion to remove has been duly served in advance. Okay, so we can say they have complied with the notice in a way, but for a wrong purpose, because wanatumia special resolution. Now 3, right to make written representations is also an advice to SUMA. Under section 141(4), SUMA may within 21 days after the notice is given submit written representations concerning the proposed removal and request the company to notify its members of them. The company must then state in the meeting notice that SUMA has made representation and send a copy to every member who receives notice of the meeting. So within 21 days after the notice is given, you can advise Mr. SUMA, hey, you need to write, you have the right to make written representations if need be, and they will be considered during the meeting. If the company fails to circulate the representations because they were received too late or through its own default, SUMA may then require them to be read out aloud at the meeting under section 141(6). So there is no excuse that the representations were made late. So you can require them to read them aloud at the meeting. So the representation should address the audit findings, deny or explain the alleged corruption where appropriate, and provide supporting documents. They should avoid defamatory or irrelevant material, since the company or an affected person may apply to court to prevent circulation of defamatory representations. So when the examiner tells you that SUMA had written representations and he had decided now to make defamatory statements, that is prohibited under section 141 of the Companies Act. So that is a right to make written representations. Then right to attend and be heard. So under section 141(2), SUMA is entitled to attend and be heard when the motion is discussed, whether or not he is a shareholder. He may challenge the evidence, explain his conduct, and ask members to reject the resolution. His removal without a proper opportunity to be heard will be procedurally vulnerable. Kenyan courts have recognized the importance of a special notice and the affected director's right to be heard, including in Mohamed Jelle Omar versus Ali Salal 2020. The 5th point will be members may nevertheless remove him. This is the point that Ringera stood to ground, that SUMA's protest rights are procedural and do not amount to a veto. If proper notice is given, the meeting is validly convened, is afforded his statutory rights, and the members pass the ordinary resolution, his removal will generally be valid. Removal from office also does not automatically determine whether he committed corruption. Any civil recovery, criminal investigation, or regulatory proceedings will require their own legal and evidential basis. Then 6, compensation and other remedies. Under section 139(6), removal does not deprive SUMA of any compensation or damages payable for termination of his appointment. He should therefore review the company's articles, his service or employment contract, any shareholders agreement, and the terms governing his remuneration. He may claim damages for breach of contract where appropriate, although such a claim will not ordinarily restore him to office. He should also verify that the company files the required change of directors with the registrar only after a valid resolution. So the conclusion is that SUMA should promptly submit written representations within statutory 21 period and attend the meeting to oppose the allegations. He may challenge the process if the special notice, meeting, or hearing requirements are breached. Nevertheless, the members may lawfully remove him by an ordinary, not special resolution if the statutory procedure is followed. So that is the reason why I told Ringera that identification that they are using the wrong special notice as a special resolution is also a marking point. So the examiner did that deliberate, and we see the question carries 6 marks. So he expected you to have content. Resolution required for removal is an ordinary one. Do you have provision? Yes, under section 139. Now, do you know the requirement for special notice? Where is it provided for? It is through an ordinary resolution for such purposes, and the notice should be given under section 139 and send a copy to Mr. SUMA under section 141. Then, do you know that SUMA has a right to make written representations? And then says yes, because of section 141(4). After receiving the notice, you will do a written representation within 21 days. And then that resolution should be circulated to the members in advance, and if it is not, then it can be read out aloud in the meeting under section 141(6). And do you know that Mr. SUMA has a right to attend and be heard? So Ringera told us he is avoiding the route of constitutional angle, etc. or right to fair hearing, but we have seen courts now telling you there is section 141(2) under the Companies Act that Ringera told us that Suma is entitled to attend and be heard when the motion is being discussed. And do you know that members may nevertheless remove him? And that was well explained. It is a private company and it is not his own company, etc, etc. So compensation and other remedies, in fact hata kama kampuni ni yako, it can be removed. So compensation and other remedies, did you advise Mr. Suma that even after removal he's still entitled to other benefits? So what are the service? So it is not in conflict with the employment law. So employment rights will still suffice even if you are removed as a director. Imagine those are the marking points that the examiner was looking for. So I believe that was a detailed one. He may expose something, at least anything to do with such kind of questions, tutakonga tunapata as much. So I believe now mumeanza kunotice a pattern. Because of frequent and consistent attendance, kuna vitu zimeanza ku come out, because I was in a position to know there is written resolution, but for private companies lazima uite meeting. So kama wangeita meeting in this question, automatically ninge flag off because it's a private company. But ingekuwa public company, uambiwe that they have decided to do a written resolution, what could have triggered me? That is illegal. So now you can now connect dots. This time examiner anauliza hivi, next time anauliza vile. Wakati tunafika our paper, you will notice a pattern. A direct inaitwa circumstantial evidence. Hii exam tuna approach na circumstantial evidence in this way. This is a strategy. The circumstantial evidence must be so strong and well connected to form a conviction. So our analysis of the bar examinations should be so strong in a way that ina lead to a direct pass. And if the chain is appearing to be broken, in that tumeweka mpaka prediction set to prevent a situation where a question cannot be repeated. So tukaweka prediction set. Na hiyo prediction set pia ikikosa kukua captured, what will we do? After doing all bar examinations, I've reserved the last month. The last month itakuwa na interim review of the legislations. Kama professional ethics, have you analyzed the practice rules? Tunapiga analysis. So hiyo inaitwa the general overview to bring any possible question that the examiner can think of from the laws provided in the course outline. Hapo tumebag kila kitu na tunaingia exam. So that is my closing statement. I now wish to end the session. Naona 6 imefika, watu wajipange waingie job. Unless there is a closing remark, I wish to end the session. How is the strategy? So let us end the session. I greatly appreciate your attendance. See you in the evening. Lakini in the evening pia iko 50-50, we will have to ndawaambia based on the circumstances. Thank you.